Calendar Finance Sector Hybrid Report, February 14, 2026. Warning disclaimer, place at top of video and description. This report is not legal, financial, medical, or official advice. All content is news, analysis, and commentary only. Do not treat any anecdotal stories, market movements, or sector discussions as personalized advice. Always consult licensed professionals for decisions involving finance, law, or health. Keycap 10 major topics, 3 paragraphs each, 5 to 7 sentences per paragraph. 1. Market sentiment, cautious optimism meets volatility. Paragraph 1. Market sentiment on February 14, 2026 reflects a blend of caution and selective optimism, driven by uneven momentum across growth and technology sectors. Short bursts of buying activity have been counterbalanced by hesitation in cyclical stocks, suggesting investors are still processing macroeconomic signals. The environment favors measured positioning rather than aggressive risk-taking, especially as traders digest inflation data and earnings updates. This dynamic has created a landscape where intraday swings are common, but conviction remains limited. Investors appear more focused on studying sentiment shifts than executing large directional bets. Paragraph 2. The broader market's behavior aligns with a pattern of recalibration following January's inflation report, which came in slightly lighter than expected. Despite the softer inflation reading, major indices failed to rally meaningfully, signaling that investors may be waiting for clearer confirmation of policy direction. The S&P 500 closed nearly flat, while the Nasdaq dipped, reflecting tech sensitivity to rate expectations. This muted reaction underscores how markets are increasingly data-dependent and less reactive to single-point surprises. The Dow's modest gain further illustrates the fragmented sentiment across sectors. Paragraph 3. Underlying this cautious tone is a broader shift toward long-term strategic reassessment. Investors are evaluating operational efficiency, automation, and productivity-driven companies as potential safe havens in a cooling valuation environment. Rather than chasing rapid gains, many are prioritizing recurring revenue models and durable competitive advantages. This shift reflects a desire for stability amid policy uncertainty and uneven sector performance. As a result, capital is flowing more selectively into firms with clearer paths to sustainable growth. 2. Inflation dynamics, softer data but limited market reaction. Paragraph 1. January's consumer price index rose 0.2%, slightly below expectations, bringing annualized inflation to 2.4%. While this represents progress toward the Federal Reserve's long-term target, markets showed little enthusiasm. The S&P 500 barely moved, and the Nasdaq slipped, indicating that investors may view the report as insufficient to shift policy expectations. The muted response suggests inflation improvements are now priced in, and traders want more consistent data before adjusting risk exposure. This dynamic reinforces the market's current data-sensitive posture. Paragraph 2. Cheaper gas and used cars contributed to easing price pressures, but core inflation remains sticky in several service categories. This mixed picture complicates the Fed's path forward, as policymakers must balance cooling headline inflation with persistent underlying pressures. Investors are watching closely for signals from upcoming Fed speeches and economic releases. The market's reaction indicates that inflation alone is no longer the dominant driver of sentiment. Instead, it is part of a broader mosaic of macro indicators. This shift reflects a more mature phase of the disinflation cycle. Paragraph 3. Institutional analysts emphasize that inflation's trajectory will continue to influence sector rotation patterns. Growth and tech stocks remain sensitive to rate expectations, while defensive sectors may benefit if inflation moderates further. However, without a clear policy pivot, markets are likely to remain range-bound. Investors are increasingly focused on operational fundamentals rather than macro speculation. This environment rewards disciplined, fundamentals-driven strategies over momentum chasing. 3. Federal Reserve outlook, policy sensitivity at the forefront. Paragraph 1. The Federal Reserve remains a central force shaping market behavior in early 2026. Recent speeches from Fed officials highlight ongoing concerns about inflation persistence, labor market dynamics, and the impact of AI on productivity. Policymakers are signaling a cautious approach, emphasizing data dependence and the need to avoid premature easing. This stance has reinforced investor expectations of a slower, more deliberate policy path. Markets are responding with heightened sensitivity to Fed communications. Paragraph 2. A key theme emerging from February's policy discussions is the Fed's focus on structural shifts in the economy. AI-driven productivity gains, evolving labor market patterns, and changes in consumer behavior are influencing the Fed's long-term outlook. These factors complicate traditional models used to forecast inflation and employment trends. As a result, policymakers are adopting a more flexible framework. Investors are adjusting their expectations accordingly, anticipating a more nuanced policy trajectory. Paragraph 3. The nomination of Kevin W. to a key policy role has added another layer of interest to the Fed's evolving stance. Institutional analysts are watching closely for how new leadership may influence regulatory priorities and monetary strategy. While no major shifts have been announced, markets remain alert to subtle changes in tone. This heightened attention underscores the Fed's outsized influence on market sentiment. In the current environment, even minor policy signals can trigger significant market reactions. For economic momentum, resilient consumer activity supports growth. Paragraph 1. Despite policy uncertainty, underlying economic data points to steady growth and resilient consumer activity. February's webcast from Hancock Whitney highlighted strong spending patterns and stable employment trends. These indicators suggest the economy retains momentum even as inflation cools. This resilience provides a buffer against potential market volatility. Investors are incorporating these signals into their long-term positioning. Paragraph 2. Consumer resilience is particularly notable given the mixed inflation environment. Lower energy and used car prices have supported household budgets, while wage growth continues to outpace inflation in several sectors. This combination has sustained demand across key industries. However, analysts caution that consumer strength may moderate if policy tightening persists. Markets are watching for signs of fatigue in discretionary spending. Paragraph 3. The broader economic picture suggests a transition phase rather than a turning point. Growth remains intact, but the pace is uneven across sectors. Investors are increasingly focused on identifying industries with structural tailwinds, such as automation, energy innovation, and digital infrastructure. These themes are shaping capital allocation strategies for both institutional and retail investors. The result is a more selective, fundamentals-driven market environment. 5. Sector rotation, tech sensitivity, and cyclical hesitation. Paragraph 1. Technology stocks continue to experience heightened volatility as investors reassess valuations in light of evolving rate expectations. Short bursts of momentum have been followed by sharp pullbacks, reflecting uncertainty about earnings durability. This pattern underscores tech sensitivity to macro signals, particularly inflation and Fed commentary. Investors are increasingly differentiating between high-quality, cash-generating tech firms and speculative growth names. This selective approach is reshaping sector leadership. Paragraph 2. Cyclical sectors, meanwhile, are showing signs of hesitation. Despite improving inflation data, industries tied to economic cycles are struggling to gain traction. This reflects concerns about policy tightening and uneven consumer demand. Investors are adopting a wait-and-see approach, favoring defensive positioning over aggressive rotation. The result is a fragmented sector landscape with no clear leadership. Paragraph 3. Energy and industrials are emerging as potential bright spots, driven by innovation and long-term infrastructure trends. February's market analysis highlights several companies in these sectors making headlines for strategic pivots and operational improvements. These developments are attracting attention from investors seeking durable value. As markets remain volatile, sectors with structural tailwinds may outperform. This dynamic is shaping capital flows across the market. 6. Company movers, February's most watched stocks. Paragraph 1. February's market analysis identifies 10 companies driving headlines across sectors, from 52-week lows to energy innovation. These firms represent a cross-section of market sentiment, highlighting both challenges and opportunities in early 2026. Analysts emphasize transparency and fundamentals as key to navigating this environment. Investors are closely monitoring earnings updates, strategic pivots, and sector-specific catalysts. This focus reflects a broader shift toward fundamentals-driven investing. Paragraph 2. Several companies in the tech and consumer sectors are experiencing valuation resets as markets reassess growth expectations. This has created opportunities for long-term investors willing to look past short-term volatility. Meanwhile, energy and industrial firms are benefiting from innovation and infrastructure spending. These contrasting trends illustrate the market's fragmented nature. Investors are responding with selective positioning. Paragraph 3. The companies highlighted in February's analysis serve as a microcosm of broader market dynamics. Some are navigating operational challenges, while others are capitalizing on emerging opportunities. This diversity underscores the importance of company-specific research in a volatile environment. Investors are increasingly focused on identifying firms with durable competitive advantages. This approach aligns with the market's current fundamentals-driven posture. 7. Capital flows and institutional positioning. Paragraph 1. Institutional investors are adopting a more disciplined approach to capital allocation in early 2026. This shift reflects a desire to balance risk and opportunity amid policy uncertainty and uneven sector performance. Analysts highlight the importance of operational efficiency and recurring revenue models in attracting institutional capital. These themes are shaping portfolio construction across asset classes. Investors are prioritizing durability over momentum. Paragraph 2. Private equity firms are also becoming more selective, focusing on companies with strong fundamentals and clear paths to value creation. This disciplined approach reflects a broader trend toward quality over quantity in deal-making. Investors are increasingly wary of speculative valuations and are demanding greater transparency. This shift is reshaping the landscape for mergers and acquisitions. Capital is flowing toward firms with proven resilience. Paragraph 3. Institutional positioning is also being influenced by macro themes such as AI adoption, energy transition, and digital infrastructure. These structural trends are driving long-term investment strategies. Investors are seeking exposure to sectors with durable tailwinds and scalable growth potential. This approach reflects a desire to navigate volatility with a focus on long-term value. The result is a more strategic, fundamentals-driven capital allocation environment. 8. AI's impact on labor markets and financial strategy. Paragraph 1. AI continues to reshape labor markets and financial strategy, prompting policymakers and investors to reassess traditional models. Recent Fed discussions highlight the transformative potential of AI in productivity and workforce dynamics. These shifts have implications for inflation, wage growth, and long-term economic stability. Investors are watching closely for how AI adoption will influence corporate profitability. This theme is becoming increasingly central to market analysis. Paragraph 2. AI's impact extends beyond labor markets to financial operations and risk management. Companies are leveraging automation to improve efficiency and reduce operational costs. This trend is particularly pronounced in sectors such as banking, insurance, and asset management. Investors are evaluating which firms are best positioned to capitalize on AI-driven efficiencies. This analysis is shaping capital flows across the financial sector. Paragraph 3. The integration of AI into financial strategy also raises regulatory considerations. Policymakers are exploring how to balance innovation with oversight, particularly in areas such as algorithmic trading and credit risk assessment. These discussions are influencing market expectations for future regulation. Investors are monitoring these developments closely. The intersection of AI and finance is becoming a defining theme of early 2026. 9. Global market influences, China tech and international trends. Paragraph 1. Global markets continue to influence U.S. sentiment, particularly developments in China's technology sector. Investors are monitoring regulatory shifts, competitive dynamics, and innovation trends in key Chinese industries. These factors have implications for global supply chains and cross-border capital flows. The interplay between US and Chinese tech ecosystems remains a focal point for analysts. This dynamic is shaping international investment strategies. Paragraph 2. International trends in energy, infrastructure, and digital transformation are also influencing global markets. Investors are evaluating opportunities in emerging markets with strong growth potential. These themes are shaping global asset allocation strategies. Analysts emphasize the importance of diversification in navigating international volatility. This approach reflects a broader shift toward globalized investment frameworks. Paragraph 3. Global macro conditions, including inflation trends and policy decisions, continue to impact U.S. markets. Investors are monitoring central bank actions across major economies. These developments influence currency markets, commodity prices, and cross-border capital flows. The interconnected nature of global markets underscores the importance of international awareness. This theme is central to hybrid finance analysis. 10. Investor behavior, strategy shifts in a data-driven market. Paragraph 1. Investor behavior in early 2026 reflects a shift toward data-driven, fundamentals-focused strategies. Markets are increasingly sensitive to macro signals, earnings updates, and policy commentary. This environment rewards disciplined analysis over speculative positioning. Investors are prioritizing companies with strong operational fundamentals and recurring revenue models. This shift is reshaping market dynamics. Paragraph 2. Retail investors are also adapting to the new environment, focusing on long-term positioning rather than short-term trading. This trend reflects a growing awareness of market volatility and macro uncertainty. Analysts note that retail participation remains strong but more measured. This shift aligns with broader market trends toward fundamentals-driven investing. Retail behavior is becoming increasingly sophisticated. Paragraph 3. Institutional and retail investors alike are emphasizing risk management and strategic diversification. This approach reflects a desire to navigate volatility while capturing long-term opportunities. Investors are increasingly focused on sectors with structural tailwinds, such as automation, energy innovation, and digital infrastructure. These themes are shaping portfolio construction across the market. The result is a more strategic, disciplined investment environment. 7 subtopics, 1 paragraph each, 7 sentences. Subtopic 1: Soft inflation's impact on tech valuations. Soft inflation data has provided temporary relief for tech valuations, but investors remain cautious about long-term earnings durability. The sector's sensitivity to rate expectations continues to drive volatility. Analysts emphasize that valuation resets may create opportunities for selective long-term positioning. However, speculative growth names remain vulnerable to macro shifts. Investors are differentiating more sharply between high-quality and high-risk tech firms. This selective approach reflects a broader shift toward fundamentals. The sector's trajectory will depend heavily on future inflation readings. Subtopic 2: Energy innovation as a market stabilizer. Energy innovation is emerging as a stabilizing force in an otherwise volatile market environment. Companies investing in infrastructure and clean energy technologies are attracting institutional interest. These firms benefit from long-term structural tailwinds. Investors view energy innovation as a hedge against macro uncertainty. This trend is reshaping sector rotation patterns. Analysts highlight several companies making headlines for strategic pivots. Energy remains a key theme in February's market analysis. Subtopic 3: AI's influence on wage growth and productivity. AI adoption is influencing wage growth and productivity trends across multiple industries. Policymakers are monitoring these shifts closely. The Fed has highlighted AI's potential to reshape labor markets. Investors are evaluating how AI-driven efficiencies will impact corporate profitability. This theme is becoming central to macroeconomic analysis. Companies leveraging AI effectively may gain competitive advantages. These dynamics are shaping long-term investment strategies. Subtopic 4: Consumer resilience amid mixed inflation signals. Consumers continue to show resilience despite mixed inflation signals. Lower energy costs have supported household budgets. Wage growth remains strong in several sectors. This combination has sustained demand across key industries. Analysts caution that consumer strength may moderate if policy tightening persists. Markets are watching for signs of fatigue in discretionary spending. Consumer behavior remains a key driver of economic momentum. Subtopic 5: Institutional discipline in capital allocation. Institutional investors are adopting a more disciplined approach to capital allocation. This shift reflects a desire to balance risk and opportunity. Analysts emphasize the importance of operational efficiency and recurring revenue models. These themes are shaping portfolio construction. Investors are prioritizing durability over momentum. This disciplined approach is reshaping market dynamics. Capital is flowing toward firms with proven resilience. Subtopic 6: Global tech competition and market volatility. Global tech competition continues to influence market volatility. Developments in China's technology sector are particularly impactful. Investors are monitoring regulatory shifts and innovation trends. These factors have implications for global supply chains. The interplay between US and Chinese tech ecosystems remains a focal point. Analysts emphasize the importance of international awareness. This theme is central to hybrid finance analysis. Subtopic 7: Fed communication as a market catalyst. Fed communication remains a major catalyst for market movements. Investors are highly sensitive to policy signals. Recent speeches highlight concerns about inflation persistence and labor market dynamics. Policymakers emphasize data dependence.